Tom, thank you for joining me for our Thought Leader Spotlight series. I'm your host, Matt Camp, head of partnerships for DealMachine. On these, we really try to shine a spotlight to experts like yourself to hear your inspiring stories and educate our audience on lessons that you've learned and really how you see the world evolving. So today, I'm really excited to welcome on Tom Wheelwright. Tom is a world-leading expert as a CPA. He's the CEO of WealthAbility. You're the best-selling author of Tax-Free Wealth, which is in the Rich Dad Advisor series, and you're actually the CPA for Robert himself. And a global speaker with him. I know you host a couple of popular podcasts and then you contribute to places like Entrepreneur and been in places like Forbes, Wall Street Journal, all over the place. And then you yourself are also a real estate investor. So you're going to speak on your expertise today on how to eliminate income taxes from real estate deals. And that's how you do it yourself as well. So you really practice what you preach. So welcome on, Tom.
Thank you. I mean, that's a way better introduction than I could do. So.
Try to come in here prepared and ready, excited to have you on too. So yeah, I mean, today we're really going to dig in on investment strategy and reducing your taxes and all of that. But to start, just to get a little bit deeper than just a standard bio, can you tell us a little bit more about your personal journey and then your journey through real estate investing too?
Yeah, so I grew up in Salt Lake City, Utah. So I was a good Mormon boy, spent 2 years knocking on doors in Paris and getting rejected by Parisians, which was a great experience. And I learned to love France at the same time. And then I spent a couple of years at the University of Utah to get my undergraduate in accounting and a couple of years at the University of Texas to get my master's degree in tax. I spent 7 years with Ernst & Young, including 3 years in the National Tax Department in Washington, D.C. I spent 4 years as the in-house tax advisor for a Fortune 1000 company here in Phoenix, Arizona, and spent 14 years as an adjunct professor in the Masters of Tax program at Arizona State University. 25 years building, buying, selling CPA firms. And for the last several years, besides my travels with Robert, which I actually like to call it that, my travels with Robert all over the world, we've been developing a network of CPAs, a worldwide network of CPAs, and we're now in all throughout the US and Canada. So that's our big thing. And that actually came about because of the travels with Robert, because people would always come up to me and say, where do I find somebody here, to do what you're talking about? And of course I didn't have anybody, I couldn't help them. And so we decided we'll just train them. So that's what we're doing right now. It's pretty fun. We have a very different philosophy about taxes that comes through in my book, Tax-Free Wealth, which is that the tax law is fundamentally a series of incentives. And I love that. I love talking to real estate investors because the incentives really highly favors, especially since 2017, highly favor real estate investors. So it's great to be with you, Brian.
Yeah, and we'll make sure to link to your book as well in the YouTube description here too. But I'd love to start there. I mean, I think one strategy that I really loved how you outlined it is kind of the 3-minute investment decision. Which can you tell us more on like why you created that and the background of that?
So what happened was a number of years ago, Matt, as we were developing our whole system for reducing taxes, what really was obvious to us was that people didn't have a really good strategy or plan of action for building wealth. And we'd ask them, what are you going to do with your money? Because what you do with your money has a major impact on how much tax you pay. Okay, it may seem obvious, but it's actually a much bigger truth than most people would think. Different people, different investments get taxed different ways. So what we did was we start looking at, all right, so what do people do? What do professional investors do? And because what we really found is that people like Ken McElroy, I know you've had Ken on your show, Ken, professional investors, they follow a pattern. And one of the patterns we saw is that they'd start with, okay, what kind of asset class am I going to deal with? And what kind of asset within that asset class? So when you look at a Ken McElroy, for example, he's doing Class B apartment buildings, and he's doing them in tier 2 markets. And, you start going through and you go, wow, he's got a pretty specific set of rules that he follows. And that's why he'll look at 400 deals and only pick one. right? To even put an offer in on. And so we kind of we actually identified that pattern. And it's one of the things that Robert taught me was you always start big and then you go small. And what most investors do is they start small and they never see the big picture. So what we have to do is we have to start with, what type of asset am I going to invest in? Is it going to be real estate? Is it going to be business? Is it going to be agriculture or energy? What is that? And then start narrowing it down. So where the 3-minute investment decision comes from actually is I was, as we were developing this, I was at a seminar with Robert and I was on a break and I got a call from my finder. I call him my finder, the broker who was finding me real estate deals. And he said, so I got a deal for you. I said, cool. And he starts telling me all about it. And so I said, stop. I said, just tell me, does it meet my criteria? Because we'd sat down, we'd gone through very detailed criteria for investing, and I didn't want anything outside that criteria. If it didn't meet the criteria, I don't even want to look at it. And he goes, yeah, it does. And I said, great. I said, how much is it? And when do you need the money? And that was it. And so what we found is, we found two things, two consequences of this. One is really only takes 3 minutes to make a decision because you are looking at very specific criteria for making that decision, and you're not going to vary outside that decision. The other thing that we found is, and I call this the blue Honda rule. So pretend that you want to buy a car and you do all your research and you go, man, the best car in the market says Honda, and man, it's looking cool and it's blue, and and you go into the dealer and you give him all your criteria for it, right? Everything that you need. And he says, gets on his computer, he looks it up, he goes, this is great. I've got one coming in 3 weeks. So for the next 3 weeks, what do you see? Everywhere you go, you see blue Hondas. And that's actually, there's a technical term for it, which I never can remember. And that what happens is the same thing happens with real estate and with investing, is that when we get really clear on what we're looking for, all of a sudden that's what we see. So the biggest issue, as you know, you guys should know, the deal machine is finding deals, right? That is the biggest issue for investors. And until you get to that criteria, it's a lot harder to find the deal. But once you get that criteria, the deals they just come hand over fist.
For sure. Yeah. I can't remember the name of it either, but yeah, what you're looking for is what you're going to find.
Yep.
You said, so it's about clearly having that vision. So can you kind of walk us through how to, I would say that 12 criteria framework, and then also how to come to those numbers, like how to find that niche, how to, clarify your vision a little bit?
Absolutely. So again, what you're doing is you're going big to small. So first of all, you have to decide, what type of real estate am I going to invest in? Okay. Am I going to invest in single family homes? First of all, am I going to invest in residential, commercial, or industrial, right? Those are the three categories of real estate. I personally, most of my investment is in commercial. Okay. I like commercial properties because I like properties that relate to my business. So which one is it? And then you look at, okay, now what type of property within that? So for example, do I want class A, if I'm in commercial, do I want class A office space, class B office space, or do I want back office, or do I want retail? What specific type of property am I looking for? So if it's real estate, if it's residential, am I looking for a single family home, duplex, fourplex, multifamily? What am I looking for? And then I have to get even narrower and say, okay, so let's say I'm looking for single family homes. Do I want a 3-bedroom, 2-bath, or do I want a 4-bedroom, 2-bath? Or do I want a 2-bedroom, 2-bath? Or do I want a condo, right? So I'm going to get really specific, and as specific as I can to the type of real estate that I'm looking for. And then I'm going to start developing criteria around that. So for example, I'm looking at neighborhood. I'm looking at price. I'm looking at loan to value. I'm looking at cap rate. I'm looking at cash on cash returns. I'm looking at, and everybody's got their own criteria. So we don't say, one criteria is better than another, though I do believe that probably the most important criteria you've got is cap rate. because it should be the basis, I think, for all this, pretty much the fundamental basis for all decisions. If the cap rate gets too low, you sell, right? If the cap rate gets too high, you go, what's wrong with my property? So there's a lot of things that you can learn from a cap rate, but on top of that, it's just getting these numbers in place and deciding. Okay. Some people, for example, I was talking to a client yesterday. He goes, I don't want more than 40% loan to value. Great. That's your criteria. Okay. Well, that affects cash flow, doesn't it? So if you're looking at a specific cash on cash return, you're going to get a higher cash on cash return at a 40% loan to value than you are at an 80% loan to value. You're just going to have fewer properties, right? That's what's going to happen. So, but that's your decision. And I don't think there's a right and wrong there. I think what's important is that it's something you're comfortable with and that it's a decision that you're willing to live by, because these are the criteria you're going to use for every single investment.
Yeah, I love that. I mean, is there, when you're going through creating those criteria and establishing that, especially as a new investor, are there any really common pitfalls you see or any common mistakes that you're saying, hey, make sure you don't, do this or this?
The biggest mistake is people don't set their criteria at all. I mean, and I would say 99% of investors never set the criteria. We have people come into us and say, yeah, I already know what I'm doing. I said, great. What are your criteria for investing? What do you mean? Okay, well, so you don't really know how to invest unless you know what your criteria are for investing. I can tell you every single one of Ken McElroy's every one of his criterion, and yet at the same time, I'm not in his company. I don't see him day to day, but I've heard him on stage so many times, and he's so consistent with what he does. Well, that's why he's so successful. Okay, it's because he follows the same criteria. That's the biggest mistake people make, is they don't stick with their criteria. It's no different than a stock investor. You say, how does a hedge fund lose money? I mean, conceptually, it should be impossible by definition. A hedge fund hedges their bets, so they should never lose money. Well, why do they lose money? Because they don't follow their criteria. So it doesn't matter what type of investing you're doing. I don't care if you're in the stock market, business, or real estate. You've got to stick with your criteria. Now, let's say that you have these criteria and you go out and you look and look and look, and guess what? You're looking for a 12 cap rate on a Class A property. I'm going, it's not going to happen. Okay, you do have to be a little realistic here. You want a 12 cap rate, you're going to be in a Class C or Class D property. Okay, you're taking a much higher risk because there's a risk reward to that cap rate. And at the same time, you go, okay, but what is a reasonable cap rate that meets my goals and that meets the current business climate? I mean, we have interest rates at 3%, on loans. You don't need an 8 cap rate like you used to when you had a 6% interest rate, right? I mean, you can live with a 5 cap rate, and you'll see it. You see a lot of multifamily deals right now at 4 or 5 cap rates, but that's okay because they've got long-term interest at 3%. So It all works.
Yeah. Yeah. I mean, I think establishing that criteria as well, I mean, that's going to make you more referable, more, easier to build your team, right? Are there any other
Well, that, you make a good point. I mean, Robert's always saying that investing is a team sport, right? Mm-hmm. And you don't do this by yourself. Well, imagine you've got people out there looking for properties for you. You've got mortgage broker out there. You've got all these different people. Wouldn't it be nice if they knew exactly what you were looking for, right? Mm-hmm. And then on top of that, you can even compensate them based on what you're looking for. Okay, here's what I'm looking for. You find something better than that, I'll give you a bonus. So we've done that before, and very successfully, that all of a sudden you get a realtor's attention, right? If they get a bonus for finding something better than what you're expecting. So, team members knowing what each other's doing, knowing what the criteria are, knowing what to expect, setting expectations is a big part of business. And the reality is investing ought to be treated as a business and should not be treated as a sidelight.
Yep. Yeah, I mean, I think a lot of people listening to this too, they're new investors. I mean, we definitely have advanced investors as well, but some new investors who, like you said, maybe they fall into that 99% that haven't established that criteria yet. Going into that, how do they find that clarity? Like, is it just an experience thing where they, get out there and start making, how do they establish that to begin with, you know?
Well, you always have two choices in life, right? You can learn from your own mistakes or somebody else's. And you know, this is what we do for a living at WealthAbility, is we actually help people develop their criteria. That's the very first thing we do. First of all, they have to figure out why they're doing it. So that's their dream. You know, what's your goal here? What are you really trying to accomplish here? But once you establish that, then you can start drilling into this, start building your team. I think some kind of a coach, mentor, strategist, advisor, it's really tough to do this on your own. It really is. It's very tough to do it on your own. It's much easier to do it in a conversation. It's much easier to do it when you have somebody with you that's kind of helping you through it. Certainly, we have a whole set of courses that help people through it. So, you know, we've kind of established that pattern, and people follow the course, and then they have the advice, and it all kind of works together. So that's ultimately the easiest way to do it in my mind, and actually the cheapest way to do it, because, you know, the most expensive thing to do, right, is to go out and do it yourself and make the mistake and lose a bunch of money on an investment.
Right. Yep. Yeah. And that brings me to really wanting to dig in on kind of what you do at WealthAbility, because I know you guys, you help them with that. And then in general, you help investors reduce their taxes by, I think it's at 10 to 40%. So I'd love to, and again, I'll link to that on the description here about, you know, courses and follow-up information there. But in that content, you really talk about kind of this 5-step framework on eliminating income taxes from your real estate deals, or at least reducing them. So can you maybe talk us through that playbook and you know, those 5 steps? Sure. and make, you know, it was so actionable. I'd love it for our audience to hear about that.
Yeah, absolutely. So there's really only 5 ways. If you look at the tax law in our country and every other country, by the way, because they're all the same. There's really only 5 ways to reduce taxes. Okay. The first is deductions, right? What kind of deductions are there? And the great thing with real estate, because it's a business, okay, again, and only if you treat it as a business, do you qualify for this? But really just about anything can be deductible. So the question, when you're working, for example, with a tax advisor, the question should not be, is this deductible? You know, if I hold up this coffee mug and you say, okay, is this coffee mug deductible? That's the wrong question. The right question, the better question would be, how do I make this coffee mug deductible? And because anything can be deductible. I mean, literally anything. Robert and I were in Santiago, Chile, and we were talking about deductions for automobiles. And this tax attorney from Santiago comes up to us at lunch and says, you can't do that here because automobiles aren't deductible. So the next day, true story, Robert comes to me right before we start the event, and he says, I want you to teach them today how to deduct automobiles in Chile. So I'm going, okay, great, we'll figure it out. You know, if you trust it, it'll work. And sure enough, we figured it out. So to the extent that the attorney came up to me afterwards and said, I would never, ever have thought of doing that. And that absolutely would work. And so everything can be deductible. So we'll think about that. That means that meals that you're currently not deducting could be deductible. And right now they're deductible at 100%. So travel could be deductible. Educational courses could be deductible. Now, these are things that normally are not deductible, right? Any of those things you do personally, they're not deductible. But again, we can make them a business deduction simply by following simple steps to make it a business deduction.
Yeah.
Okay. The second thing is what we call conversion. And this is, I think, the biggest one for your audience, frankly, is because what most people don't realize is that if you're doing fix and flips, you're in business. You're not an investor. You're in business, okay? And there's nothing wrong with being business. I'm in business. So you're in business. You know, I love being in business. But business has different tax requirements than investing has. So if you're in business and you're fixing flipping and you're doing this in your own name, as you know, Garrett Sutton would tell you, okay, so you're a sole proprietor, and sole stands for someday you'll lose everything. And so you don't want to do that from the asset protection side, but the other side of it is you're subject to full highest tax rates, income tax rates. You're subject to Social Security tax at the highest rates. So you're going to pay like 60% in tax if you do that. Well, let's say all you did was convert that sole proprietorship to an S corporation. Well, you lose that 15% self-employment tax just by converting to an S corporation. So now you're converting the income from what we'd call earned income to ordinary income. Then you can convert it a second time. Okay, now let's, instead of fixing and flipping, why don't we hold it for long term? Now we can convert it to portfolio income, which makes it capital gain, which taxes it at half the rate. Okay, so now we've gone from a 60% rate to a 20% rate. Okay, now we can actually do that, go one more step, and we can convert it to tax-free income. And what we do there is we hold it. We do 1031 exchanges. And when we need money, we borrow, because when you borrow, there's no tax. So we actually call that a buy, borrow, die strategy. And I talk about that in Tax-Free Wealth. But basically you can see, and we go through this in our courses, you can go all the way from highest tax rate to zero tax rate simply by, in the exact same investment, simply by changing how you do it. Okay, so this is the conversion process. We go through this with every client because there's all sorts of things you can convert from high taxable income to a lower tax rate. The third thing we want to keep in mind is tax brackets. So everybody has tax brackets. Warren Buffett has tax brackets, right? He's got a 0% tax bracket. He's got a 10% tax bracket, and he's got a 37% tax bracket. All right, well, we all have those same tax brackets. Well, who else has those tax brackets? Well, our children have those tax brackets, and our parents have those tax brackets, and they may not be using all of their tax brackets. So we may have this really high income at 37%, but we've got kids over here that aren't using their tax brackets at all. And that's just an unused asset. That's what that is. That is a non-producing asset is what we'd call that. Well, we want to make that a producing asset. So what we do is we walk clients through is, okay, are there ways to involve children in your business so that you can shift some of your tax burden to them at a lower tax rate? Okay, so that's a third way to do it. The fourth, of course, is there's all sorts of tax credits. So we have low-income housing credits, for example, in real estate. We have solar energy credits, which are coming back big time this year. And we're going to see massive solar energy credits. And these are things we put on real estate, right? I mean, solar is something you don't just build a solar panel and put it on the ground, right? I mean, you're actually building real estate for this. I actually built a porte cochere just for my solar. So I had solar panels. And so you've got that, those credits. You've got education credits, of course. Now we have these big dependent care credits and child credits and so forth and so on. So credits are dollar for dollar. So they're way better than deduction, where a deduction might be worth 40 cents on the dollar. A credit's worth $1 on the dollar. And some of the things, for example, what you're doing at DealMachine, you've got to have research and development tax credits because you're developing a completely new technology. Well, guess what? There are big credits for that. And I'm sure you're taking advantage of those. And then, of course, the last thing you can do is you can always defer. You can always postpone the tax. Probably my least favorite thing, and very few of our clients ever get to deferral, even though 95% of the public, that's the only thing they know, and they call it a 401k. I'm not a big fan. I will say, I'm going to be very public about this, as I typically am. I am not a fan of holding real estate in a 401k or an IRA. I think that's a bad idea. And I think anybody tells you it's a good idea is trying to sell you something. And if a tax advisor tells you that's a good idea, you probably need a new tax advisor. So any good tax advisor who knows real estate, and the way I got into real estate, you were asking earlier, is my technical specialty is partnerships. And of course, most real estate is done in partnership. So when I came to Arizona, I actually headed up the real estate tax department. When I went to the Fortune 1000 company, it was actually to head up the real estate group, handle the taxes for the real estate group. So taxes and real estate and partnerships all go together. So I've been doing that for many, many years. And then when I found Robert Kiyosaki's cash flow game, I started playing it. And I remember the first time my partner and I played it, we go, we got to buy real estate. And literally within 30 days, we had our first deal done, and never looked back, which is crazy because my parents had duplexes when I was growing up. So for me to have to wait 15 years before I bought my first piece of real estate was just crazy.
Yeah, I mean, it's funny. I mean, there's so many people in our audience that have that background too of, oh, I read Rich Dad Poor Dad, and that's what got me into it. I mean, that's myself as well. Like that was the first experience I had with anything around why real estate is such a powerful asset. So yeah, very, very relatable for our audience. But you did briefly touch on, because I know you said like obviously a lot of people in our audience, they're operating a business, they're doing wholesaling, fix and flip, more transactional stuff. I would love for you to talk a little bit more about the long-term rental side and why you're so passionate about that as a strategy and why it's so valuable.
Well, there's the magic word in tax is depreciation. So depreciation is I actually call it the magic of depreciation in my book. And the reason it's magic is because you buy real estate, and so you buy, let's say you drill for oil. Okay. When you sell that oil's gone. You don't have that oil anymore. So of course you get to take a deduction called depletion for the oil going away. All right. Well, with real estate, you get a deduction for the real estate, even though it's not going away, even though it's still there. So you can have a building, literally you could have a 300-year-old building and get depreciation on it. In the US, we have a very odd law right now. And I call it odd because to me, I think it's unique to the world, and it's a very unusual one where we actually get bonus depreciation on real estate, meaning that on the land improvements and on the contents of the building, the day you buy it, even if it's used property, you get an immediate deduction, and that could be up to 25 to 30% of the cost of the property. So you put $100,000 into a property. Let's say you put $20,000 in, and the bank puts $80,000 in. You could end up with a $30,000 deduction day one, even though you only put in $20,000 of your own money, and that's only through depreciation. And you do not get that on properties that you flip. So it's only on long-term hold. So the magic from a tax standpoint is on the long-term hold. On top of that, of course, when you sell it, instead of being ordinary income, it's capital gain. And you can do a 1031, which is the like kind exchange, buy another property. It's funny because people will say, well, what if I want to get out of real estate? I'm going, why would you ever get out of real estate? I mean, why would you do that? You can always borrow against the real estate. So you don't really need to get out of it. And if you really want to have, completely nothing to do with real estate, go buy a Walgreens. I mean, for heaven's sakes, get a triple net lease. Do something where the bank's relying on the tenant's credit, not on your credit. And there's just so many different options in real estate. And the great thing about a 1031 exchange is it's any kind of investment real estate for any other kind of investment real estate, as long as you're within the United States. So you can have raw land that you exchange for Superdome, right? I mean, it doesn't matter. You can do those exchanges. And on top of that, we have bonus depreciation. You don't get any of that when you fix and flip. So the nice thing though about the flippers is that you guys actually have access to finding the best deals. And so you're going to find some that you go, I want to flip this property, and others that you go, I want to hold this property, because some are better for, making money on the flip, and some are better for making money in the hold. Well, that requires a more complex structure of how you hold it from a tax standpoint. And that's where you need somebody like WealthAbility on your team to help you set that up right, so that you're not paying too much tax on either side, either the long-term holds or the flips.
Yeah, I mean, I'm a big fan of, like you said, of wholesaling or fix and flipping. Some of them and holding the rest. Holding the best and flipping the rest, right?
Right.
Or wholesaling the rest. We definitely have people who kind of combine the short-term and long-term strategy like that. So that's great advice. When it comes, I know you talked on like bonus depreciation, all of that. You also speak on like cost segregation a good amount. Can you maybe speak to, define that and talk about like, how to do that process?
Yeah, it's actually fairly simple. You do have to have a professional do it, by the way. The IRS does not allow you to do it and doesn't allow your accountant to do it. Okay, you need to actually have a professional. It's usually a team of engineers that does a cost segregation. All they're doing is they're looking at when you buy a property, when you think about it, you can kind of break that property down into 4 categories, right? You buy the land, which never wears out. You buy the building, which wears out over a very long period of time. And then you buy the land improvements that wear out at a faster rate than the building. And then you buy the contents of the building, like the ceiling fans, the floor coverings, it's cabinetry and so forth. And those are depreciated at different rates. So we've always urged people to do cost segregations even before we had bonus depreciation, because I'd rather deduct something over 5 years than over 40 years. I just want my money now, because if I have my money now, I can reinvest that money and I can actually get even more depreciation next year. So I want to constantly be using that money. I don't want to be giving it to the government. It actually becomes a bit of a habit. It's very habit forming. You actually have to keep investing. It actually has to become an addiction. Otherwise you start paying tax. So what happens is with the cost segregation is these engineers, they break down these costs. They give you this big long 40-page report, which you hold on to. And then if the IRS ever questions it, you give them the report. And typically the IRS is going to say, okay, here's what's an interesting one is that I've heard people say from time to time that, oh, cost segregation, that's aggressive. And I'm going, actually, according to the IRS, according to the Internal Revenue Code, a cost segregation is required. Now, the IRS doesn't require it because they're okay getting their money faster. But the law actually technically requires it. So this is not an aggressive thing. This is actually the right thing to do. And if you don't do it and then later you do it, that's actually a change from an incorrect method to a correct method. So, and by the way, you can catch up in a cost segregation. So let's say you bought a property 5 years ago, didn't do a cost segregation. You can do it today and catch up all the depreciation this year that you should have taken over the last 5 years. So cost segregations are beautiful. They're a great thing. They're very cheap compared to the return on investment. And anybody who doesn't do a cost segregation, I think is making a mistake most of the time, unless they just have no tax at all. And then that's fine. But I think, I always think the properties need a cost segregation.
Yeah, good tip. Do you think, I know you briefly before touched on, and you said Robert obviously talks about this often, but building a team and how important that is, and the process of doing that. Can you maybe speak to that a little bit, and then tell people like, hey, here are the top team members you should be thinking about, and here's why each of them matter?
Sure. So yeah, investing is definitely a team sport. I mean, people who do it themselves why would you do something yourself that you're not that good at? And why would you spend all the time learning it instead of letting somebody else who's already done it do it for you? So, of course, I'm a little prejudiced. I think the top member of your team, besides yourself, of course, should be your bookkeeper. And it should be a very good bookkeeper. And it should not be your spouse, your mother, or any other relative, unless you're teaching your children how to do bookkeeping. And then I'm okay with that. But for the most part, a bookkeeper should be a professional bookkeeper. They're the ones who make sure that you have accurate information so that you can make good decisions. Then you have the next person on your team is your accountant. Now, the accountant is different from the bookkeeper because the accountant, their job is to analyze. So the bookkeeper's job is to have is accuracy, and the accountant's job is analysis. And you got to keep those two separate. And the accountant should be actually helping you analyze your numbers, analyze, how are you doing? And then of course, analyze the tax consequences as well. So the accountant's very important. Your attorney is another very important person, particularly both an asset protection attorney. You probably actually need 2 attorneys. You need an asset protection attorney, but you also need a real estate attorney, somebody who specializes in real estate transactions. Certainly somebody who can write leases for you, can review leases, can review contracts for you. So I have actually several different attorneys on my team. And then my mother always said that one of the most important people in your life is your insurance agent. So I'm a big believer that, if you look in the dictionary under the definition of tenant, all it has is one word: plaintiff. Because every tenant has the potential of being a plaintiff, right? And the old adage is, it's a question Garrett always asks. I always see him ask when we're on stage together. He says, so how many of you have not been sued yet? So if you're in real estate, you're going to be sued. That's the fact of the matter. So a good insurance agent is actually very, very important. Obviously, a good banker is very, very important. And I'm a big believer that one of the most important people on your team is a property manager, because I don't want to be managing that property. I want somebody else managing that property. I'm right now in the middle of changing my property managers because that happens, right? I had what I thought for a while was a good property manager, and then he couldn't lease my property. And if you can't lease a property, it's not a good property manager. So probably a good clue there. Again, we all have challenges. we're all learning here, but having those people on your team, I think that's, and then of course you got to have a good finder, right? A good deal maker. So, I think what you guys are doing is amazing to provide the deals and to help find those deals. Because I think that's a huge piece that people tend to miss. And I think another thing that I think is important is to look at what role do you want to play, right, on the team? Because different people should be playing different roles. I've got friends that they're really high fact finders. They love the due diligence. You do not want me doing your due diligence. I'm not good at it. I would be terrible doing your due diligence. But you want me to negotiate the deal? I can do that all day long. Okay, so the other thing we look at is okay, what type of person, what type of natural instincts do I want? What type of energy do I want on my team? So we go through, like Blair Singer's book, Code of Honor, is very important to us because you need to make sure that everybody's on the same page. This is why your criteria for investing is so important, but also it's why your values and your code of honor is so important. So, we actually wrote a book. I've got it right here. The Rich Dad Advisors wrote a book together called More Important Than Money. And this is a great book. This is about building a team. And so you talk about team, I highly recommend this book. One of my favorite books that I've ever participated in, just because I think the topic is, it's underutilized. People don't talk about teams. And yet when you look at every great business or every great investor, they always have a great team around them.
Yeah. I think I love your strategy of figuring out like what role do you want to play, like understanding your own strengths. So that way it's going to inform who to bring in first. But can you maybe, I think there's probably a fair number of people who they're getting into that first deal or they're hustling and kind of doing everything, taking the DIY approach and doing a lot of things themselves. When is the right timing to bring in a team? And then is there a mindset shift that they need to make to know like, hey, I don't need to do this all myself, right?
Well, Rich Dad, Poor Dad didn't come first. What came first was the game cash flow. And what I would suggest is people ought to play that game multiple times. It's called cash flow. You can play it online. It's not nearly as good online as it is in person on a board game. But what we do is we actually have our clients play the game, and most people play the game like, in fact, everybody plays the game like they invest, right? And most people, first thing they're doing is rolling those dice, right? They're rolling the dice. That's what we do when we invest, right? If we go out and start investing right away, we're just rolling the dice. Well, that's a pretty risky way to invest. An alternative way to do that is to actually spend the first 15 to 20 minutes before you start rolling the dice, developing a plan of action, putting your team together, developing a plan, creating your criteria, doing all that first. And so we've actually done an experiment multiple times. And what we've discovered is when you have players that they all have the same strategy, now they're all playing individually, but they all have the same strategy and they're still helping each other out, guess what? They all win the game 3 times as fast as anybody who starts rolling the dice right off the bat, unless they get lucky, right? You can get lucky rolling the dice for sure. But if you want to be absolutely sure that you're going to win, the way to do that is to create a plan of action, what we call a wealth and tax strategy. But you really need to create that plan of action first and build that team first. And if you did that before you ever invested, you would be way more successful.
Yeah, I love that. That's great, Tom. I appreciate your time today. I don't want to run too far over on you today, but thank you so much again. What's the best way for people to get in touch with you, to follow up with you and learn more about what all you're working on?
Well, so a couple of things. First of all, my podcast is the WealthAbility Show. So I encourage you to listen to my podcast.
We'll link to that. Yeah.
We also post it on YouTube. And then my book, Tax Free Wealth. I've actually been told it's a great beach read. So summer's coming up, a good thing to take to the beach with you, just a little light tax reading. It's actually meant for the uninitiated. That's who it's intended for. It's not intended for it's not written for CPAs. It's written for the general public. So I would suggest that. And then I would suggest, of course, if you need help finding a CPA, you want to actually get into a really good system, you want to build your strategy, then just contact us at wealthability.com.
Fantastic. Awesome. Tom, thank you so much again for coming on today. I really enjoyed this conversation.
Hey, thank you. This has been great. Thank you very much. Thanks for letting me talk about something other than tax. Actually, I love talking about the team and the strategy and everything else.
Yeah. I mean, your wealth of knowledge. I'm going to have to do this again down the road, but to everyone watching this again, is Matt Camp with DealMachine, and happy deal finding.